Guys, quick visual. See these eggs? See this basket? We'll call it Company A. When we invest solely into Company A, we are essentially dumping all of our eggs into one basket. And if the stock drops, we lose our eggs. Now we have a ton of baskets. Look, pretend they're baskets. When we spread our investments over each basket made up of different stock options and bonds, oops, market crash, but we only lost a few eggs instead of the whole barrel. This is what we call diversification. And if you want to learn more about investing and how to diversify, stay tuned. Welcome back. Thank you for joining me for part 2. If you are not new, then you already know that you are about to be empowered with the knowledge that's going to help you build generational wealth, because I'm revealing the financial education that we do not learn in high school. So let's jump right into it. When it comes to investing, in addition to the fear of possibly losing your money, people also steer clear of it because they just don't understand it. And I don't recommend anyone invest without having at least a basic understanding. First basic, an investment is a monetary transaction with an end goal of making a profit, a return on your investment. And no, honey, that pair of shoes is not an investment. I keep saying money is not complicated. Well, neither is investing, really. No matter how difficult people try to make it, there are no tricks to this. This could actually get boring, but this simple understanding could make you some pretty good money. If you want to skip to the areas that interest you or straight to diversification, the timestamp links are in the description box. There are several types of investments, and we're going to cover the basics: stocks, bonds, and investment funds. Stocks. When you purchase stocks in a company, you are purchasing shares of ownership. Simply put, when you own a small business as the owner, you are the main or only investor in your business ventures. You are investing your time, your money, your efforts into your small business goals. When a company goes public, they sell shares to their company, meaning they are sharing ownership with everyone who buys stock in their corporation. Anyone who buys stock in a single company is investing their money with the hope of realizing a future return based on that company's success. The ways that stocks provide that return are through dividends and capital gains. When a corporation is faring well, they may choose to share their profits with their stockholders. By the way, if you have invested in a company, you are a shareholder or a stockholder. Not all companies pay dividends, and those that pay relatively high dividends are considered income stocks. Capital gains are when prices increase. Ever heard of buy low, sell high? Well, this is where that would fit in. If you buy shares at a low price and you notice the prices are rising, you could trade them for a profit. As I said in part 1, share prices don't have as much to do with a company's earnings as you would think. It's very emotional. Quick example, if investors flock towards one particular company, that demand will shoot the stock prices up. Nothing to do with the actual valuation of the stock though. When Steve Jobs resigned, Apple stock dropped. Traders as in stock traders, but traders reacted to the news questioning the future of the company, and their actions drove the prices down. Again, nothing to do with the actual company earnings. We can go much deeper into this, but I will discuss stock valuations and the intricacies of the stock market in a separate video. Moving on to bonds. Bonds are basically loans, and you are the lender. When you purchase bonds, you are investing into the company by lending the money in exchange for interest payments over a specified time, and your principal is paid back to you when the bond matures. Your principal is the amount you loan the company. As a bondholder, you are a creditor to the firm, not an owner of the firm. Bonds are not only issued by companies, but also the U.S. government, cities, and international entities. Within each investment is inherent risk. The more risky the investment, the greater the anticipated return. But because you don't know what that return will be, positive or negative, therein lies the risk. Bonds are typically less risky, and they also yield lower returns. The key with bonds is if a company has to liquidate, creditors are paid before stockholders. Shareholders tend to get the short end of the stick when a company faces bankruptcy. Hence, stocks tend to be more risky than bonds, but also have higher payouts. Bonds issued by the federal government are U.S. Treasury bills, and they are risk-free. The rate offered by Treasury bills is called the risk-free rate, so you can imagine the return is relatively low. I don't want to start throwing a bunch of financial lingo at you, but financial managers, we are trained to study and calculate standard deviations and beta because they measure the risk of investments. Use of that data, along with risk-free rates, help to determine the expected return of an investment. And they measure two important types of risk. Those are systematic risk and unsystematic risk. Stay with me, guys. I know it's a lot. We're almost done. Systematic risk is the market risk. Inflation, random occurrences that affect the economy as a whole. Every company is susceptible to the factors of systematic risk. But unsystematic risk is specific to each company or a small group of companies or assets. That being the case, unsystematic risk can be diversified away. Remember our eggs in the baskets? Well, when you invest in one company, you inherit all the risk for that company. So if there is a market downturn or the company goes under, you do risk losing it all. Which brings me to investment funds. What mutual funds and index funds do is allow you to spread your wealth amongst several investment options. Why is this beneficial? Well, let's look at 2020. COVID did cause an economic collapse, but not every company lost value. Case in point, some businesses lost value, but there were a lot of industries that soared. I'm sure investors in Charmin are plenty happy right now. So let's say your fund included stock in airline companies and stock in tissue manufacturers. The return you would have gained here would help cushion the loss here. Say a loss of 8% but 15% gain here. If you were only investing in the one, then you would lose 8% of your investment. But by diversifying, you actually realize a return of 7%. Mixing stocks and bonds are another way to diversify. Referencing the 2008 economic crisis, although the S&P 500 index suffered a great loss, bonds actually earned a return. A diversified portfolio of stocks and bonds might have suffered in 2008, but losses would have been much smaller than those experienced by an all-stock portfolio. In part 3, we're digging a little deeper into mutual funds and index funds and how to maximize your investment returns. Hope to see you there.